name is J.U. I'm the co-founder of undergroundtrader.com. I've been around for over 15 years. You can see the various publications, my books, videos that have been out. Uh, been through the whole gamut, from the So's Bandit days to the internet mania, bear market, decimalization, real estate bubble, internet bubble, um, quantitative easing, HFTs, algos, and everything that you're seeing right now. And I want to talk about right now, this market environment that we're seeing every day. It's ironic because we see the indexes marching higher, yet the volume is thinning out. Okay, volume, overall market volume has been steadily declining for the past 5 to 6 years. And yet the market is, the benchmark indexes are hitting all-time highs. And one of the reasons for this is because of all the algorithm trading programs that are out there. And I'm sure you guys have all heard of high frequency trading programs. I'm sure you've heard of dark pools. But that is the new environment that we're in right now. And I like to call this environment the thunder and tumbleweeds landscape. And that is because you have moments of just thunderous action. Liquidity, prices move fast, you get follow through, there's price flexibility, okay? You get profits extremely fast. It's like hitting the fast forward button on your DVR. And then you get tumbleweeds. All of a sudden, well, not all of a sudden, but gradually the volume thins out and you end up pretty much getting erosion out there, and you see the tumbleweeds pretty much rolling by. Okay, thunder and tumbleweeds. And that is the result of all these algorithm programs and the HFTs, which also, they've seen their heyday from 2009 to the end of 2011. And because of the saturation of algorithm programs, because everyone's co-located on the exchanges now, you have the natural law of transparency. Once things become too transparent, okay, just like everything, once things become too transparent, it's like a bubble, and then transparency hits, and you get the erosion factor that comes in. So, in addition to the regulators and all that stuff. So basically now, we're in a market that's very thinned out, and you have to play in what I call wet climates. Okay, during the market day, you have wet periods and you have dry periods. A wet climate is one where you do have the follow through, you have the momentum, and that's because you have all these algorithm programs. These HFTs are leapfrogging over each other. What HFTs do is they like to kidnap liquidity, okay, and ransom it out at the highest price. Now, if you got into a position before the HFTs jumped all over it, then you're loving it because prices are spiking so fast. Okay, they're spiking so fast, and there's a rush of liquidity out there. But if you hold on too long or you get too greedy, the bids tend to evaporate. Okay, so once that explosive move peaks out, and if you're not paying attention, if you don't have a system that measures when the momentum is hitting the red line, okay, literally like when you're jamming the gas in your car, gas pedal, and when you're redlining it, if you don't have something in place that lets you know that, hey, the momentum, we're redlining it right here. This is the max point of liquidity and transparency. You got to get out. If you don't have something in place, okay, then you're going to be in trouble. Now, take the proverbial iceberg. When you watch National Geographic Channel and they talk about icebergs, everyone sees this. They see the top of the iceberg. But the reality is 90% of that iceberg is under the water. And this applies to a lot of things in life. especially in trading. See, too many traders, all right, they'll see this. They see the gains. They see how much money you can make. They see, you know, hey, Twitter is hit whatever 40% gain on the first day of trading. Okay, they see the surface, the shallow information, and this is all transparency at a point where it's too transparent. And with the markets, the name of the game with trading is to find that transparency and react on it before it becomes too transparent. You want to be selling into the liquidity, and you want to be selling into that transparency. Now, when it comes to trading, and we delve into the makeup of a trader, okay, like I said, when you just read books, when you just go by stuff you see on the internet, what you see is just the tip of the iceberg, okay? What you don't see is all of this. And this is the foundation that has to be built and galvanized from beneath the surface so that you can get to a point where you are hitting consistency and you are deriving an income from trading. So traders see this, they think, hey, this is easy. You know, you make a couple good trades, you catch some runners, unaware that you're hitting the peak of transparency. And it's like the minefield theory. You know, when you get thrown into a minefield, you know, person freezes up, he closes his eyes, you know, and he just he covers his eyes and he walks straight. He makes it out of the minefield alive, and he thinks, "Wow, I did it. I can do it." That's how you deal with a minefield, okay? And obviously, he gets thrown into a minefield next time. What happens? Or the time after that, he blows up, okay? That's why you have to have a system. You got to get your education, and you got to be trained to work your way up and build your foundation. All right, and like I said, this iceberg principle applies to so much stuff, especially when it comes to trading. You know, when you see something hit new highs on your intraday scanner or new lows, okay, that is a point of transparency. That's what the algos want to do. They want some publicity. They want to advertise, hey, this stock is hitting highs, just to suck in more buyers. So this is an underlying theme that you want to keep with yourself. Understand, too many traders focus on the surface while overlooking what lies beneath. So what lies beneath when it comes to a trader? What is the bottom part of that iceberg? And this is what I call the 4 stages of trader evolution. The first stage is your acclimation stage, where you learn the tools, you learn the basic building blocks, and I'm talking very, very basic. The basics of price action. You know, what makes a hammer a hammer? Okay, what makes a shooting star candle a shooting star? Why is that a reversal? So learning the most basic stuff, the essence of the tools, is absolutely critical. That's the first stage. Now the thing is, most traders, they understand that first stage. They say, okay, all right, I'm going to start from the first stage. Okay, now from that second stage, you get to the conditioning process. And this is where traders try to rush it. And during that conditioning process, you want to take the templates and the sequences that are taught in the first stage, and then it's the application. And you have to slowly work your way through this conditioning process, the second stage of evolution. And this conditioning process can take weeks, months, okay? Some people are a little slow. Could take years. All right? Now, if you're doing it on your own, if you have someone guiding you, that is what speeds up this process, so that ultimately you get to the seasoning process. And this is where you are refined. You've been through the conditioning process. You've created and you've built templates. And templates are blueprints of your behavior. Okay, not only just templates as a trader. how you react, on panics. How do you react during certain patterns? How do you react to certain types of rhythms? You've got it all. You got it all down. Okay, that's when you hit that seasoned trader stage. And once again, that can take years. Okay, it's all individual. And then ultimately you get to the specialization stage, which is down here. Oops. And that's when you realize, hey, you know what your strengths are, your strengths, you know what your impediments are, and perhaps you find something, 5 or 6 stocks that you really acclimate to, that you know it like the back of your hand, and then that's when you can size up, almost become like a specialist. Okay, because that's what specialists do. Right? Specialists, market makers only handle a handful of stocks. Specialists only handle 1 or 2 stocks. And so everything is laser pinpoint as far as your focus, as far as your activity is concerned. But those are the 4 stages of trader evolution. So the seasoning stage is where most traders, once you hit the seasoning stage, then you can pretty much derive a consistent income from your trading. So what is seasoning? Well, when we take that word and we apply it to outside of trading, we can apply it, you hear about it, you hear that word being used for all types of stuff. For food, well, seasoning does what? It enhances the flavor. For wood, those of you who have fireplaces, all right, seasoning the wood means that you dry it out, okay, you get the moisture out of there, and you make it more suitable so that it can burn. For cast iron, for those of you who cook on cast iron pans, okay, seasoning can take a long time. You have to use that pan, and then you've got to you got to put oil in there, and with these cast iron pans, people have owned their cast iron pans for 50 years. Okay, they've been passed down from generation to generation to generation. The most seasoned cast iron pans, they feel like nonstick pans because the oil fills the pores. It adds flavor to the meals. People swear by them. And then for a trader, it means that you've been around the block. Not that it's not something that's gauged on time. Okay, how long you've been in the market, how long you've been trading, because what tends to happen is that people tend to get clogged, like a sink gets clogged, and then that shortens that cuts off the evolutionary process, and it leaves you with a short-sighted template that doesn't improve, and therefore you cut off the circulation as far as the evolution, the flow, the enlightenment. And what you want to make sure is to find someone or have a system, okay, that is going to help to plunge the clog, to free things up so that you're once again able to grow. The enlightenment seeps in. Your objectivity, your ability to spot, okay, transparency before everyone else sees it. And that's really what it all boils down to. To be able to spot buy fades, sell fades, to be able to spot something before the market completely reacts to it. These are the attributes of a seasoned trader. Okay, once again, the templates have been galvanized. It doesn't mean that you're perfect, okay? But it means that you've been there and you're able to step back and realize or see what you're doing wrong, okay? And be able to adapt to it or cut yourself off. If you only trade the wet climates and just completely stop trading the dry climates, that's going to improve your trading multifold. Because in the markets, it's not hard to make money. The hardest part is keeping that money. Okay, and I'm sure you guys can attest to that. Hardest part is simply keeping the money. So once again, a seasoned trader, and it's always going to be a work in progress. Okay, it's always going to be a work in progress, but it's a learning process. And one of the most natural pleasures in life, okay, is learning. And you know what makes that learning process even more fulfilling? When you know what the voids are when it comes to your trading, when you know where the gaps are, that's when you can really appreciate good training. It's like someone who just moves into into a new place, and they don't have a couch. In fact, they don't have any furniture. So the first 2 months they're sitting on the floor, they're eating on the floor, okay, and they're deprived of a couch, okay, or a bed and a table and a chair. They're deprived. And for those of you out there who've been around for a while, been around for a long time, okay, you are the ones who actually feel that deprivation, because you know what it felt like to have a nice bed. You know what it felt like to have a nice cushy couch. But it's gone, okay? So how much do you appreciate it when you do get a new lazy boy? How much do you appreciate it when you have something to sit on, when you have a bed? It's that deprivation. The deprivation points out exactly, it pinpoints exactly, hey, your butt's hurting. That having a chair or a couch, that's what you need, okay? So with the right training, this is what the right training does. That it provides the couch, it provides the furniture, and it's most helpful to those of you who have been deprived. Now you can go at it on your own, try to figure it out, okay? Or you can go with a system or a training program that has been put together specifically for those of you, who have the mental clog. Get that mental metabolism going again. So anyway, attributes of a seasoned trader, bottom line is they are able to see and react, grab that transparency before the market does. Okay, battle calm, harness consistency, and the bottom line is to end up generating income on a daily basis. That's what it all boils down to. Now, with our system, okay, I've created through the years, and painstakingly through the years, I've created a basic tool, what I call the rifle charts. And this is all done on the ChoiceTrade platform, okay? And ChoiceTrade has the ChoiceTrade platform. So we can provide the template for you also, so you don't have to figure it all out, and you don't have to figure out all the coordinates to plug in. But basically the rifle chart is very simple. Just takes simple moving averages, a 5-period moving average, okay, a 15-period moving average in green, and actually this is a 1-minute chart. So on the 1-minute chart, we don't use a 15-period moving average, right? However, 5-period moving average, a 15-period simple moving average, 50 and 20-period simple moving averages. All right, now 50 and a 200-period, 200-period is in red, okay, or pink right here. 50-period somewhere up here, so if it's not within the vicinity, it's not going to show up. And then we use our Bollinger Bands, which are in white, which have an upper, middle, and a lower envelope. In the middle is actually a 20-period moving average. So you take the moving averages, and we use that as a roadmap. The moving averages, what they do is they give us a blueprint or a roadmap of the buying or selling pressure. Okay, they quantify the actual trend when it forms. It quantifies the supports. It quantifies the resistances or the nominal targets. Okay, it quantifies the trading channel. But just having a roadmap is one thing. And what I mentioned earlier about, you can jump into a position and you can be right and still lose money. Okay? Obviously, the opposite's true too. You can be wrong and still make money, all right? But you can be right and still lose money. And when we go back to talking about the liquidity and the wet climates, you can be right on a stock, you can be right on the direction, but the problem is, and you can get a perfect entry, problem is, if you do not have something that's going to tell you, hey, the momentum's peaking out here, you need to start taking your money off the table, you'll end up losing money. All right, so just getting in is only a fraction of the equation. It's the exits that matter the most. It's the exits that matter the most. So that is why we have a stochastics indicator, which is composed of two stochastics. The yellow is the lead stochastic, and the green is the laggard stochastic. And the 80 and 20 bands, these are momentum bands that when they first hit, you're going to get a deflection attempt. When they pierce, it takes effort to pierce through. Same thing on the downside. When stocks sell off, you'll notice once they hit that 20 band, they're going to try to bounce. They're going to try to coil. When they can't coil much higher, then that's when they form what I call a mini inverse pup, and they collapse through. On the flip side, you're going to get stocks that bounce, okay? And they're going to hit that 80 band. It's going to try to deflect, but when they hold long enough and they form what's known as a mini pup, that's when they actually squeeze, okay? And that's only part of the methods here, but just utilizing this rifle chart alone, it's going to give you a new perspective on what exactly a stock is. What is this instrument, this being, this creature that when you look at it, just on just a straight level one quotes, the price movement seems so random. The correlation seems so random at times. After all my years, what I've spent those years doing and finding out, learning out painstakingly, okay, learning the hard way, is these rifle charts. And we put these on 7 different time frames, of which 4 are used on intraday. 5 are used intraday. And when you have these rifle charts, okay, it makes sense out of stock price movements. See, the surface of the iceberg, when people see a stock price jump or drop, the first thing that comes to their mind is what? Is there news? Is there some kind of news that's out there that's causing this move? Number one. Number two, well, are the indexes dumping? Because on any given day, 70% of a stock's movement is correlated to the benchmark indexes, okay, the S&P 500. And that's why traders like to watch the futures. But this is going to give you the real breakdown of what's going on with the price action. So having the rifle charts is one thing, all right, and learning the methods, learning the patterns, like the mini pups and the mini inverse pups, that's one thing. Okay, but being able to apply them and execute them, that's a whole different ball game. And that's why the training from the ground up, from beneath the surface, is something that's a requirement. Now, anytime you make a trade, what I call a trade sequence takes place. And this is all part of putting together and building a proper template. A trade sequence is composed of 3 parts. And you know how they say, plan your trade and trade your plan? All right, well, this is the plan your trade portion. Have your premises set up. Have your pattern formations set up. What type of pattern is it? Is it a perfect storm? Plan A, plan B? Right? Is it a cup and handle? Is it a wedge, falling wedge, bull flag, bear flag, whatever? Have your pattern set up. Have your bumpers set up, which are the support resistance levels and the key moving average price levels. That's the pre-trade. When you're in the trade, take your entry, take your position. Now you have the monitoring and the managing part, as well as constantly gauging the risk and the probability. Okay, not risk reward. Risk reward, you know, that'll apply to swing trades, but I'm talking about intraday trading. And when you're trading intraday, you know, everybody says, well, you know, I want a 1 to 3 risk reward. I want a 1 to 2 risk reward. Okay. Well, market really doesn't care what you want. But in those equations, once again, that's the surface. That's literal thinking. Okay. The lateral thinking tells you that I'll take a 1 to 3 risk. Well, no, I'll take a 3 to 1 risk reward. In other words, I could lose 3 times as much money, okay, 3 units to 1. However, my probability to hit that 1 unit is 90%. You see what I'm saying? So it's the probability that really matters here, especially with the intraday trading. Probability is going to override, okay, the risk, the reward. Now, understand something. The conventional thinking, and once again, take conventional and throw it right on, lop it right on top of the tip of the iceberg, because that's what that conventional, the shallow, visible portion of the iceberg above the water, and literal thinking, okay, they're all in the same boat. The lateral approach, the lateral way of thinking, okay, is not risk versus reward. It's risk and probability. A plus B equals C. Everybody focuses on the C, right? The C is the reward. Let me focus on the C. All I care about is the C. I want to make this much money. You know, I want to focus on the C. And people overlook the A plus B. Risk and probability. What is risk? Risk is exposure. Plain and simple. And it's derived or composed of your share allocation. Okay, how big's your position? Number 1. And number 2, the duration of holding time. The longer you hold a position, the more risk you take on. Therefore, if you want to offset some of your risk, what do? You trim down your position, correct? So as you scale down your position, that allows you to hold that position for a longer period of time. We all know stocks don't move straight up, and they don't keep moving up nonstop without a downtick. We know that. We know stocks don't go straight down forever, okay, or continue to keep selling off all day long, the full marathon from the open to the close, okay, all day long. We know they don't go straight down. So we also know that if you're going to take a maximum position, whenever you take a maximum or a large allocation, whatever your comfort level is, okay, you only want to expose that large position for the shortest duration of time, shortest period of time, of holding time. That doesn't mean you have to dump it all, but you have to scale it down the longer you hold. So that's the risk portion of the equation. What about the probability portion? Well, the probability, okay, really boils down to this. How much are you willing to accept? How much money are you willing to accept? All right? I hear people say, well, I'm in a position and I want to get 50 cents out of this trade, or I want to get 2 points out of this trade. All right? Look, on a swing trade basis, where you take stuff overnight and you can swing stuff, that's a whole different ball game. When you're playing intraday, what you want doesn't matter. But I'm sure we all can agree that a stock can move 15 cents a lot quicker than it can move $1, right? Obviously, it's obvious. So here's where the probability comes into. Probability is broken down into 2 parts. Number 1, the premises and the type of patterns. Okay, what pattern are you playing? Number 1, because they all have their own, little niches, and they all have their own probabilities. Now I'm going to tell you right off the bat, okay, with our training, the perfect storm is the highest probability pattern that's out there. Perfect storm. Okay, so that portion, that's taken care of if you play a perfect storm or just play perfect storms, number 1. Now, second part of the equation is, where do you take your money off the table? Okay, the larger your target is, the smaller your probability. Okay, so therefore, if you want to increase your probability, what do? You lower your target. Now, the other, like I said earlier, okay, the market doesn't give two scraps what you want from the trade. However, with the rifle charts, we have these things known as bumpers, just like on a pinball table. And these are critical support resistance levels. So you measure the targets literally by measuring the support and resistance levels. So understand that the nominal profits are going to be right around those bumper areas. Okay? Now, if you're willing to take even less money, you increase your probability. All right, so now I hope you all got that. A plus B equals C. Risk plus probability, okay, equals the reward. But you don't focus on the reward. See, the reward is transparency, it's profits. The reward is a footnote. The focus should always be on streamlining, on making more efficient the A plus B process. Focusing on that. That is what lies beneath the surface. And this is what traders overlook, because they're too busy focusing on trying to get C. They're too busy focusing on the tip of the iceberg. And what that results in is chasing, and falling right into the hands of the algos. They're chasing that liquidity. They're buying at the tops. They're shorting at the bottoms. Oblivious. Understand this. A well-managed loss trumps a poorly managed gain. Okay, and if you can embrace that, then that tells me that, all right, you understand. You understand. What lies beneath ultimately surfaces. Okay, but what lies beneath before it surfaces, what lies beneath is what matters. Okay, and that's where the focus should be on as far as your evolution as a trader. Now, as I had mentioned earlier, a trade sequence template is a specific template on how you execute and apply the trade sequence, the pre-trade, the in-trade, and the post-trade. But the post-trade I may have overlooked that. Not something you want to overlook, but basically the post-trade is where you simply rate, your trade. How did you perform? How did you execute? All right. Were you able to get out into that liquidity? Liquidity overrides price. All right, and anyone who's been in a position too long, okay, will know. Everybody and their grandmother can be on the bid, and this stock can look like it's going much higher. And that's what the market wants to do. It wants to show you that so that you're going to stay, or you're going to chase, or you're going to add. And then once the 1 minute stochastic peaks out and slips that 80 band, the bids evaporate. Liquidity overrides price. And all of that put together is what your trade sequence template is all about. See, a proper template is going to ensure consistent results. And you're going to be able to continue to harness and manifest your evolution. A sloppy template, okay, and believe me, every one of you has a template, is eventually going to end up in catastrophe. Because what the market does is it exploits your weaknesses and exploits your impediments. It just does. And if you don't have a foundation underneath that you've worked your way up to break surface, okay, then that's the market is going to find out. The market's going to expose that. Now, I want to go over a trade sequence here, just to give you an example. Okay, when I talk about the market climates, I speak about them on a macro and a micro basis. So macro market wet climate is going to be during the earnings season, okay, where the market will move. The market has volatility. And then as the earnings season dries up, that's where, well, the market volume tends to dry up. So we have a wet climate during earnings season, okay, and then the dry climate in between. Now, during that wet climate during the earnings season, well, what exactly does that mean? It means opportunity, because when companies come out and they report earnings and they get a nice gap up or a gap down, right? That creates opportunity. That creates a situation where you have funds that want to get out of this position. They're down, they're red, right? Or funds that want to buy a position, and then you've got the algorithms, the HFT programs. They're going to prey off of that. You got the market makers and the specialists. Okay, the specialists. These guys, they have order flow information. They're going to play, and then you got the retail players. So those are the four participants in the market. And in a wet climate, you have the most activity by all four participants. Now, when we go on an intraday basis, what I call a micro basis, we all know that the market's open at 9:30, close at 4:30 p.m. Does that mean that stocks are going to move at the same pace in the first 30 minutes, okay, at 11:30 or 12:30 in the middle of the afternoon? No, not at all. In fact, the first 30 to 45 minutes is what I call a micro wet climate. It's a wet climate because the day is just beginning and the prices are more lenient. You have the most volume, most concentrated volume. And as the day wears on, things get more rigid. Price levels get more rigid. And then by the end of the day, man, it's like pulling teeth just to get a 10-cent move. So it dries up as the day wears on. So the most fertile period of any trading day is going to be that first 30, 45 minutes of the day. Now you add in a component where there's a big gap down or big gap up. All right, now you take that wet climate and you've just magnified the veracity of the stress and the tension and the emotion that comes with that stock. And in essence, you have a situation that's like a live wire where you can make profits on price movement where on a normal day, may take 5-6 hours, and you can make that type of you can jump in on that type of price action, okay, in a 15, 20, anywhere from 5 to 20 minute period of time. So here's a great example. QLIK, Click Technologies. All right, earnings report, gap down over 5 points. And here's a sample trade sequence. Now, QLIK, it's a dumper stock. We always have the SPY down below. Oh, let me stop right here. All right, we have the SPY here. Okay, we use that for the market headwinds. So the SPY gives us an idea of if the market is bullish or bearish. And whenever you have something that can be used as a measuring stick, okay, because like I said, most stocks on any given day, 70% of their price movement is going to be correlated with the SPY. So if the SPY is uptrending or moving higher and your stock is coming down, well, that's known as a sell fade, okay, in a wet climate. If the SPY is moving lower and your stock is holding up, that's known as a buy fade. So long as you have volume. And therefore, it's most honest during the wet climate periods. In dry climate periods, you have lower volume, lesser participants. The algo HFTs, they are the apex predators, and they're going to try to mimic a buy fade, meaning that the SPY sells off, stock holds up, and then when the SPY bounces, what do? The stock should bounce, right? Right. And what happens? The stock pops a little bit, and it fades and sells and sells and sells right into the SPY pop. So, all right, so then you figure, okay, well, this is a sell fade. So when the SPY peaks and comes back down, well, this stock should be coming back down. And what do? They hold it, and then they grind it back up, resulting in chop, right? That's what a dry climate is. So anyway, QLIK on 10/25, morning after the earnings gap, the earnings dump, actually, okay? We have the 1, 5, 15-minute charts on the SPY and on QLIK. So what we notice right off the bat is we got a 15-minute mini pup on the stochastics. So that engine is telling us it's moving up. 5-minute mini pup, and the 1 minute forming a pup and a mini pup. Now, 2750 is what's known as a stinky 250s levels. Okay, just count them. 250 increments, 3250, 35, 3750, 40, 4250, 45. Okay, and we call those stinky 250s levels. You don't even need a chart. And then throw in 10 cents above and below. All right, 10 cents above and below the 250s area, and that provides a whole stinky 250s range. And those are de facto bumpers. They're honorary bumpers. So if a stock pops up to that 2740, 2750 range, it's like a magnetic field. It's just going to be stuck there for a while. Okay. Now, if a stock collapses through there, that's where you're going to find some support. If a stock pops up through there, that's where you're going to find some resistance. So when they hold that 250 area and they coil back up off that 250 area, okay, that's where you have an opportunity. So going back to QLIK, we notice that 15, 5, 1 minute, they're all forming what I call as mini pups, okay? And when you get 3 or more mini pups, it's what's known as a perfect storm. And we see that the SPY is coiling back up, right, to stinky 5s area. We see the buy fade. We take 1500 long at 27.94. Now notice the 1 minute 5 period moving average. That's in yellow. It's holding. The 5 minute has a mini pup, so that is up. 15 minute has a mini pup. That's up. Testing the 15 minute 20 period moving average. That's the next key bumper that needs to break. Once that bumper breaks, then we have a whole lot of upside. Okay, so taking this thing long, we have the 5 minute, once again, that forms a mini pup. We have a 1 minute that's forming a pup and a mini pup. You can automatically target the upper Bollinger Bands whenever you get a mini pup. Boom, boom. All right, so now we take a look back and we notice the price action 28. Okay, that's gonna be the first break area because that's where we peaked out. All right, now the 1 minute upper Bollinger Bands 28, 28, 28, 28, 40. That's your upper Bollinger Bands. Like I said, you have your 5, 1, and 15 minute, all forming mini pups. And for those of you who read my books, okay, or bought any DVDs, whatever, you know that all roads lead to the perfect storm. That's where you're gonna get, okay, your strongest move because all the time frames are in your favor. So at this point, we add 1,500 more shares. And then look how fast QLIC pops. Boom, sonic boom, literally. And that's your perfect storm. Boom, okay? And the thing is, you have to have your orders ready, guys, because the HFTs are going to come in and they're just going to steal all that liquidity and then hang it out there. Well, you got to be hanging your shares out there just as well. So this is what we call a perfect storm, a 1 minute mini pup and a pup. That's a double barreled pup. You got your 5 minute mini pup. You got your 15 minute mini pup. Perfect storm, right off the open. And actually, not exactly right off the open. All right, we always like to give it about 5 minutes to get that first 5 minute candle close. But between 9:35 and 9:55, okay, and 10 a.m., that's where you're going to make, that's where you can make the bulk of your gains. In fact, you can make your money there and walk away. All right, because that is the wet climate. And it's all about the wet climate. It's all about what you keep. So now as far as QLIK, all right, remember what I said. Liquidity overrides price. Well, now oftentimes, here's the best part. Your best liquidity is going to be at the highest price. Okay? Funny how that works, right? Funny how that works. Back here, all right, it looked like everybody and their grandmother wanted in on this stock. Right here. Okay? They stack the bids. Right? They stack the bids. They're punching that 1 minute 20 period moving average. Okay? Oops. And like I said, this stuff moves very fast. And that's why you got to be able to catch it and you got to plan ahead. But liquidity overrides price. That's the bottom line. Okay? And preparation is the key. You got to be prepared. You got to have those limit orders in there. All right? And once again, that's not only just about, the whole seasoning process. Okay, but this is a template. This is a template that, I'll be honest, a lot of you won't be able to, you won't survive long enough to be able to generate a template. So you got to kind of speed up that learning process, the learning curve. So anyway, make a long story short, we get the spike, okay, and we dump it. And there's one reason why, main reason, is that look at the SPY, it's selling off now. Right? So no matter how strong a stock is, ultimately it's going to correlate with the SPY. So if the SPY continues to sell off, you're going to see selling pressure, all right, ultimately kick in. So that's why we go ahead and lock that stuff out as the SPY starts to peak out. Okay, and that's the QLIC dumper trade. Perfect storm. We get in with plenty of time, plenty of liquidity, and then we catch the 1 minute mini pup thrust and sell into the spikes. Now, if you pull up QLIC on any other day, all right, pull that up any other day, it doesn't trade that much, and it doesn't move that much. Okay? You're seeing stocks in a situation where there's so much emotional, there's an emotional element involved because there is a big gap or a big gap down. And that's what we call a wet climate. All right, so just to break it down, this is what we call a 15-minute mini pup, a 5-minute mini pup, and a 1-minute mini pup. And it's called a perfect storm. And the perfect storm is what's going to be at the tip of the iceberg. Okay, the perfect storm is ultimately what you want to work your way up to be able to trade. And it's all about applying application, the application of trading the perfect storm. So what you need is specialized training that adapts to today's market landscape. Okay, the seasoning process can't be rushed, but you got to be guided. You got to know, you got to be shown, what the proper templates are. And that is going to speed up not only your learning process, but also your seasoning process. And this is what Alpha 7 Trading Academy is all about. The right training is going to encompass everything from the basic building blocks to the application of what works in today's trading environment. Galvanized training. Now, the video course alone is going to have over 30 hours and 700 slides of live action videos. And it's going to cover, well, it covers everything, okay? From your basic price patterns to market structure patterns, your classic cup and handle, head and shoulders, wedges, flags, everything. Okay, working its way methodically, laterally, and progressively towards those perfect storms and the application of the perfect storms. This is the exclusive trader training program with Alpha 7 Trading Academy. That information is on your screen. Alpha Trading